We've got the House, we've got the Senate, and we've got the presidency. You guys should be doing cartwheels. Man, oh man, I want to see some smiling face. And on top of it, the market's at another record right now as we speak.
Welcome to the February 21st, 2017 RMC.
So it was really bizarre. The day after the election, we held one of our educational workshops. And I started the seminar. I put a little song on my phone and I stuck it up to the microphone, and it was "It's a Beautiful Day." Everybody knows that song, and the audience just laughed about it. It is a beautiful time for us, isn't it? It absolutely is. But boy, a lot of this country is not too pleased with what the election results were. But is the stock market and is the economy pleased? You better believe it is. And that's what I'm here to share with you today, is just Wall Street's perspective on the election and where we find ourselves at this particular time, because it is one of the most interesting historic times in my 25-year career that I have ever witnessed. And I rode through the dot-com era, the Japanese era, the booms, the busts, everything that's gone on in between. And I've never, ever experienced a time period like we are finding ourselves in right now. So today, we're going to talk about a lot of different things, but nothing too in depth, right? You guys aren't here to learn about the micro side of the economy, microeconomics. I'm going to give you what we call more of the macro view. What's going on, help you, make some decisions maybe for your own portfolios or just conversation pieces that you can have with others, especially those on the other side that say, geez, this economy is just going to do terrible under Trump administration, and things are just not going to work out, and we're going to find ourselves in recession, and we're going to talk about the probability of a bubble and many other issues. But today is really just to kind of bring you up to date from an economic standpoint of where we find ourselves. Anybody want to take a guess? I'll give you, we'll do two raises of hands. What the Dow Jones Industrial Average, and it's not my favorite barometer, but how much the Dow Jones Industrial Average has gained since November the 9th through this last Friday? 20, 2400, and got 25, 25, 35, 35, 34, 40. Come down a little bit. 12%, close enough. We'll stop there. 11.5%. Now, under the Obama administration, it was pretty tough to eke out some of those gains, other than 2009, after our economy came this close to going into a depression, not recession, after the 2008 credit crisis. We rebounded March of 2009, and 2009 turned out to just to be a historic year because we had help from this wonderful organization called the Federal Reserve, and they put a bunch of money. Quantitative easing, 1, 2, 3, TARP, XYZ. It was all there, government intervention at its finest. But it worked, at least in retrospect it did. But what is amazing is the rebound that we've experienced in our economy just since Donald Trump was elected. Anybody want to take a guess? Why has the market gone up 11.5%? And to put it, for those of you not familiar, historically the market rises 10% per year. If we go way back to the early 1900s and we average out all the ups and the down years, we average about 10%, including the reinvestment of dividends. So how in the heck can we go from November 9th to here we are today, up 11.5%? Trust, okay, that's a good key word. Very nice, a businessman in office. Repealing regulation, ooh, getting very, very warm. Anybody else? Taxes, feel good. You know what? Every single one of you are right. And we probably could sit up here for the next 2 hours coming up with words like that. But I'm going to summarize and kind of put these words into one word that I've been using. I share this with my clients. I share this on the radio show with my listeners. And that is this. It's the O word, optimism. How many of you woke up on November the 9th and felt more optimistic about your financial future and the future of this country than you were the previous day? So if we had this room multiplied times, 10, 20,000 people, I think the vast majority would feel the same. Not all, but the vast majority. And folks, I can show you all of these slides. Monetary policy, equity earnings, fixed income, currency, populism, post-election, corporate tax reform, immigration, on and on and on. All the things that are affecting the stock market. But if we boil it all down into one simple word, that one simple word is optimism. Now, who would have ever thought, after what our country went through after 2008 and a few dicey years ever since then, that we would find ourselves day after day after day setting records in the Dow, the NASDAQ, the S&P 500. Nobody would have ever thought that. And for all the naysayers against Trump, thought, man, if this guy had one chance and you know what to even be elected, boy, the stock market sure wouldn't be excited about it. They'd probably, yawn a little bit. Boy, has he proven them wrong. So if you boil everything down, and we're going to go into some more intricacies such as GDP and strength of the US dollar and so on and so forth, it really boils down to optimism, because none of that is important if you are not optimistic about the future of the financial markets and therefore the economy and therefore the United States of America going forward. Everybody agree with that? Okay, perfect. So let's see. Okay, let's go ahead and go to the first slide. Current market levels and performance. All right, so as I just said, here we are today, once again, and I just hold my breath every time I say this. Once again, we are at record levels of the Dow, the NASDAQ, and the S&P 500. It was just a few short weeks ago that the milestone of Dow 20,000 made all the headlines. Matter of fact, we went on our Facebook Live page and I took a screenshot of my computer monitor when we hit Dow 20,000. We just got hundreds and hundreds of reviews and nobody could believe it was going to happen. Now here we are today, upwards of Dow 20,700. Just in the last couple of weeks, we've gained almost 1,000 points in the Dow Jones Industrial Average, and the same type of strength for the S&P 500 and the NASDAQ. Why? Because of optimism. So the current market level and performance, again, unheard of. Now we're approaching Dow 21,000. But as I tell everybody also, it's so fun to stand up here and be giddy and say, yeah, we're trading at record levels and so on and so forth. But at the same time, we must all remind ourselves and to pinch ourselves that this can't last forever. And the biggest risk that we run right now, I actually get more nervous in these type of market conditions for my clients than I do in kind of mediocre or even declining market conditions, because what can happen is you wake up one day and the institutional traders, who are the ones, by the way, that move the market, the institutional traders, they go, you know what, enough's enough. I've made 10, 11, 20, whatever percent they've made, and they wake up literally one morning and they begin the selling process. And we can actually give up all those gains and even more, even go negative. So you have to be very, very cautious in this type of an environment. Like I said, hard not to get giddy about it, but it's a very exciting time, but also as a money manager such as myself, it's also a very nervous time. The performance, who knows where we're going to go. Now, we work side by side with the likes of Goldman Sachs. Nice to have them in the administration. BlackRock, the world's largest money manager, and many of the most prominent Wall Street firms. And everybody has the same projection, which is modest growth for this year. I mean, they're talking 6, 7, maybe 8% growth in the S&P 500 for this year. Well, my goodness, we're almost there already. So what the fear is going forward in the rest of 2017 is once we kind of hit this apex that I was just mentioning a moment ago, and the euphoria begins to diminish, then what we can find ourselves in is a situation where the market goes, okay, Trump administration, it's time to show us, right? This is where we're on the cusp of being at this point. We've risen a lot. We got a big boost a couple of weeks ago when Trump announced his phenomenal, quote, quote, tax plan. The phenomenal tax plan gave this market a big old shot of adrenaline in the arm. And so one of the things that I'm watching very closely for my clients is if this, quote, phenomenal tax plan is not, quote, phenomenal, then that would be an excuse for the market to begin to pull back a bit. But if it is something that is amazing, buckle your seatbelts, because we're going to be in for one heck of a ride, in my opinion. Now, on the subject of tax reform, here's a little interesting statistic for you. Let me back up one step. What makes the stock market move besides this optimism? But historically, what is the number one driving force for a stock or the overall market to rise? What is the catalyst? Excellent job. Corporate earnings. That's exactly right. Here's a great statistic for you, now that you know that corporate earnings is the number one driver. For every 1 percentage point of decline in the marginal corporate tax rate, which the marginal corporate tax rate right now, it's 39.6. Historically, if you look at the S&P 500, they all set at about a 30% tax rate. If you look at the S&P 500 companies. For every 1% that the corporate tax rate is cut, so from 30 to 29 to 28, it equates to $1.50 per share of earnings for Fortune 500 companies. Yeah, that whistle was exactly the way you should react. So what does this mean in English? This means that corporate America can find themselves making a whole bunch of money. And if the stock market reacts the way that it should, based on its projections on earnings, stock market, who knows where it can stop if we get a corporate tax reform and a tax reform package that everybody feels is fair on both sides of the aisle. That's how important this corporate tax reform is, both on, definitely on the personal side, because you and I as consumers, we represent 2/3 of economic spending. So if we have a little bit more money in our pocket, we're going to go spend at the store. Those stores' sales, of course, reflect corporate earnings, and then they win on that side of it also. So it's a pretty doggone good time to be corporate America. Unless you find yourself on the wrong end of a corporate tweet or something from the president, then it's a little bit tough. But that's how important that corporate tax reform is at this point. So the overall expectations, my second point there, of 2017 is we're holding our breath right now. I wish I could sit up here with 110% optimism and say, my goodness, here we are up, 11.5% already, and here we are just mid or late February. But it's anybody's guess, because the risk that we run, I hate to say this, don't shoot me, but I think we're all grown adults in this room, is if he wakes up one day and he tweets something that really upsets the market, or as he's done a few times, and let me tell you, we're going to talk biotechs and pharmaceuticals. Just a few weeks ago, he had a nasty tweet about the biotechs and the pharmaceuticals, the drug stocks in general, and boy, he drove that sector down. And so we got to be very apprehensive that he's not going to say something, and he's got some pretty smart people around him, so I'm hoping that that's not going to be the case. But that's one of the big things. So putting that aside, the overall expectation, assuming that we're not going to get some crazy tweet or something unusual such as a terrorist attack or one of those crazy things such as that, I think this could definitely be a historic year in the market. I really do. Maybe an 8, 10, 12% return. Not the highest, definitely not the lowest, but a good, solid, what I call Goldilocks type of return. Not too hot, not too cold. Second slide. Areas of focus. GDP. Anybody want to take a guess where we are at GDP as of the end of the fourth quarter of 2016? 0.09, 2%, close enough, 1.9, good job. So, not where he wants it. Where does Trump want GDP? Oh boy, good job, you guys. Man, smart audience. Yes, that's right, 4%. On paper, it doesn't sound like much. In reality, a 4% GDP probably, in my opinion, would take an 8-year term of President Trump to achieve that. That is a big rock to push uphill to get GDP from 1.9 to 4%. Could it be done? It could. But what's the enemy of a strong GDP growth number? Starts with an I. Inflation. Exactly. So that's what we have to somewhat balance out here. If we get a strong economy, GDP is growing from 1.9 to 2 to 3 to 4%, guess what's going to come right along? Inflation. Now, who likes to control inflation, or whose job is it to control inflation in our country? The Fed, exactly. So, great analogy. If you don't understand what the Fed does, I'll make it really simple. Everybody drove a car here, I assume, or had somebody drive you. That car got here by pressing two pedals, the brake pedal and the gas pedal. Janet Yellen and the rest of the Fed does the same thing. They press on the gas pedal, meaning they lower rates to speed up the economy. They tap the brake to slow things down, as they have begun doing by raising interest rates. We've had 2 interest rate increases in the last roughly 8 years. We had the final one December of 2016, just like we did in December of 2015, 0.25% increase. Right now, the Fed has made it pretty clear in their telegraphing that they want to raise interest rates 3 times this year. Now, under the Obama administration, when there was chatter about an interest rate increase, what did the markets do? Go up or down? Down. What has the market done when the Janet Yellen was it last week or the week before? Yeah, it was last week, excuse me. She testified in front of Senator Heller and the rest of the Senate Banking Committee, and then the next day in front of the House Financial Committee. What did the market's reaction when she said, yeah, we're pretty adamant, we're going to raise rates 3 times? Okay, what else are you going to tell us? That was really the market's reaction to it. So a lot of did, because A, they haven't done well in the stock market, and B, interest rates are low, which is part of how you calculate if you're going to get your pension check next month or not. So the economy can definitely withstand higher interest rates. And right now at this point, like I said, everybody's comfortable with about 3 interest rate increases going forward. Now, just to add a little caveat here, Janet Yellen also said that at the beginning of 2016 that we're going to get about 4 interest rate increases, and we got 1. So take it for a grain of salt. But GDP growth, like I said, 1.9%. Most economists are looking to finish 2017 at about 2.2 to 2.3% range, which I think would be real comfortable. Next benefactor that we're seeing of the Trump administration is the U.S. dollar, strength of the U.S. dollar. Now, we all know, of course, we talk tax reform, immigration, repatriation of money, tariffs, so on and so forth. All of that culminates down to the U.S. dollar. The U.S. dollar looks at all of these factors I just mentioned and many more, and then the traders decide, do we have a strong U.S. dollar, a mediocre, or a declining U.S. dollar? What kind of mode is the U.S. dollar in right now? Rising or falling? Rising, exactly. Back to the optimistic side of things. Everybody, meaning Wall Street, thinks that the economy is going to improve, global trade is going to improve, everything is going to improve, so they are bidding up the U.S. dollar. Now, is a strong U.S. dollar a good thing or a bad thing for the U.S. economy? I'm hearing mixed answers, and that's Wall Street's perspective, mixed answers, right? Again, I'll use my analogy, the Goldilocks scenario. A U.S. dollar right now is very comfortable, but if the U.S. dollar gets too strong, who does that hurt? Exports, exactly. And who owns those exports? Corporate America. How do we drive a stock price up in corporate America? Earnings, right? So let's kind of go through a little scenario. This is really important also. Dollar rises. 80% of the S&P 500 companies derive the majority of their earnings overseas. So let's just pick XYZ hypothetical company that's making a widget in Germany, right? So when they produce their widget in Germany, let's say they earn 50 million euros. Well, here comes the quarterly earnings season. They have to bring those 50 million euros back to the U.S. Does a rising dollar hurt or help them in that example? Hurts them, exactly. So when they go to convert the euro to the U.S. dollar, here we go. So this is another little worry that I have, that a strong U.S. dollar, which is indicative of a strong U.S. economy, appears to be good on the surface, but you have to watch it when it comes to corporate earnings because, again, so much of the wealth of corporate America is created overseas. And when they go to bring it back, I don't care if they produce the widget in Europe or Japan or Hong Kong, it doesn't matter what country it is, a strong U.S. dollar can hurt corporate America. So once again, this is going to be one of the big challenges of Steve Mnuchin, the Goldman Sachs executive that has now become our Treasury Secretary, to kind of balance out this strength of the U.S. dollar to make it not too strong, not too weak. Let's see. Recession risk. Are we approaching a bubble? Anybody think we're approaching a bubble? Not too many. I do. But that doesn't mean that you stop investing. Doesn't mean you change your investment horizon, because your investment risk tolerance, time horizon, allocation, the holdings in your portfolios, that should be all indicative about your personal situation, your risk tolerance, your goals, your dreams, not if we're approaching a bubble. One of the most common questions I get, not so much from my clients, but from my radio listeners, is why should I invest right now at a record level? Well, my response is kind of sarcastic, but it's true, and that is, well, here we are now at Dow 20,700. What if you use that same logic at Dow 3,000, 4,000, 5,000? I still have a hat. I was, I don't remember what year it was, but I was back at the stock exchange, and they handed out Dow 10,000 hats. And here we are, Dow, almost 21,000. So if you use that logic, I don't want to invest because we're at a market top. Well, we're at a market top for a reason. We're at a market top because people are, what? Optimistic about the growth of the U.S. economy and the markets. So don't ever, let that dissuade you. But yes, are we approaching a bubble? Well, a bubble is euphoria. And this is the other risk that's going on in the market at this particular time. Investors this is probably one of the most hated rallies I have ever experienced in my career. People kind of plugging their nose, like you got a bad smell, but yet they're putting their money into the market, plugging their nose and putting their money in. Why are they doing that? Because the train's leaving the station. They don't want to be caught sitting in money markets or CDs or something that's low yielding when they hear all these returns going on. Are we at a euphoric stage of a bubble at this point? No, we're not. There's no signs of that. Your typical sign of a stock market, real estate's a whole nother deal, but a stock market bubble is where corporate earnings do not justify the earnings per share of the companies. So in other words, if the stock market gets very rich, right now we're valued at about 17 times earnings on the S&P 500. You get up in the low 20s, mid 20s, high 20s. That's when everyone kind of sits up in their chair a little bit and says, uh-oh, this market's getting very expensive. And that begins to be indicative of a market bubble. But we're not there yet. Maybe, again, if we get the tax reform and, like I said, corporate earnings skyrocket, maybe that would be one of the catalysts. But right now, I don't feel that we are at a bubble by any stretch of the imagination. Equity earnings, we touched on that. Like I said, earnings are very good, fairly valued right now. The S&P 500 versus the Dow Jones Industrial Average. Now, why did I put this one in? This was a common question that a lot of people have posed to me. Gee whiz, Dow's up now 11.5%, but why? What is doing it versus the S&P 500? Well, what you have to remember, once again, back to your personal goals, dreams, financial challenges, etc. Look at what your portfolio is doing in commensurate with the risk and the allocation that you are taking. If you want to invest in the Dow, how many stocks are in the Dow? 30. How many are in the S&P 500? About 502, actually. I know they kind of fool us on that one. And over 2,000 in the NASDAQ. So the Dow is obviously a very, very small index. So don't try to benchmark yourself or your portfolio performance to just the Dow Jones Industrial Average, because you will be shocked at some point. There are times in our history where the Dow will plummet, the S&P 500 and the NASDAQ rise, or vice versa. But a lot of people are very caught up in just what Dow's doing, and that's why I said, when I told you or asked you where the Dow is for the year, it's just a fun trivia type of question. It really means nothing. Portfolio managers do not benchmark themselves against the Dow Jones Industrial Average. Usually it's going to be against the S&P 500. Speaking of the S&P 500, let me go back to the strength of the US dollar. I forgot to mention one important point. There's a situation that is arising, and we're going to talk about it in the financials here in a couple slides, but it's important while we're on the S&P 500. So we said a strengthening US dollar, too strong, is bad for S&P 500 companies, large cap, blue chip type of companies, right? So people are asking me all the time, well, gee, should I be in small caps, the young up and coming companies? And historically, again, we're in unhistorical times, but historically, you do want to be in the young up and coming companies. Now, why is that in an environment where you have the strong US dollar? Simply because those young companies do very little commerce overseas. It's the big blue chips that tend to trade, like I said, vast majority of their earnings coming from overseas operations, where the young up and coming companies do not. So if you're kind of wondering how to hedge yourself if we start to get into a strong US dollar situation, historically, the small caps and the mid caps are a good place to be. Let's see, let's go to the next slide, Bill. Well, you know what? I'm sorry, back up. Let's talk fixed income and interest rates there. So this is the other thing that's got us absolutely scratching our heads in the market in regards to this economy. So here we have the stock market skyrocketing, right? All these records being set. Historically, what do bond yields do in this type of an environment? Do bond yields go up or do they go down? What's that? They go up, right. What have bond yields done? They've actually come down since Trump got into office. We're trading right around a 2.44, 2.45 yield on the 10-year government note right now. We shouldn't be there. We should be probably 2.55, 2.6, 2.7, somewhere around there. So this is back to what I was saying earlier, that part of the country is loving Trump and the other part is having a hard time with him. It's the same thing with the bond traders. Remember, the bond market is your best indicator of any market that is out there as to the perception of the market. Bond traders, by nature, are very, very pessimistic. They're going to be more conservative. So remember the old adage, if I don't have a pen here, but we all played on a teeter-totter as a child, right? Let me see that real quick. So this is the best lesson I'm going to give you all day. We all played on a teeter-totter as a child, right? One side goes up on a teeter-totter, the other side goes down. So if you're wondering where interest rates are going, bond yields, CD rates, that type of thing, picture the teeter-totter. You buy a bond for typically $1,000. Here's the yield that it pays. Let's say this is a 10-year treasury. 2.44 or so is where it's yielding right now. So every day, minute by minute, interest rates are changing. Well, notice when interest rates, this side of the pin goes up, what happens to the price that you paid for that bond? It goes down. What happens when interest rates go down to the bond? It goes up. Exactly. That's all that bond market's about. It's really, really that simple. So why am I showing you this? Well, right now, we've had, since the Trump election, we've had interest rates come down and bond prices go up, and Wall Street's going, wait a minute, this isn't supposed to be, right? Strong stock market, strong economy, or perception of a strong economy. bond yields should be going through the roof, but they're not. So this is, again, what kind of has Wall Street scratching its head just a little bit, saying, boy, is everybody as confident about this market and this economy as they perceived to be by investing in the stock market? And the answer is, we're going to wait and see. So you want to kind of figure out where things are going. Interest rates and bond yields should be up, but they're not. They're actually down. So this is one area that keeps us a little bit awake at night and a bit nervous. So if you kind of wonder where the market's going, just watch the bond market also. All right, Bill, now if you could, please. Okay, the financials. Boy, this was one area. So this was one area that everybody pretty much got right on Wall Street, which is hard to say because usually rarely does that happen. And that is, they said, if Trump wins, financials are going to go through the roof. Have financials gone through the roof? Absolutely. Why is it? Well, remember this great rule that the Obama administration put through and Congress passed, even though they didn't read the 2,200 pages, called Dodd-Frank? That's right. Boy, it affected our industry, the mortgage industry, affected everybody's industry, it seems like. Well, of course, there's talk of not repealing, but almost like with Obamacare, replacing some of the good or some of the bad with some of the good that's out there. This is what Wall Street is probably more optimistic about. I'd say tax reform is number one. Financial reform via Dodd-Frank is the second issue that they're very, very excited about. This was a bad rule. Bottom line, what it did, one of the reasons the market really didn't move in the last few years is very simple. Because of Dodd-Frank, many financial institutions, the large ones all the way down to our local community banks, they didn't want to lend because they were fearful that the regulators would come in and say, you don't have enough capital. Your capital ratios are not right. Here comes a penalty, big old fine, or shut them down, as we saw the Fed do and the FDIC with some of the banks after the credit crisis. So the banks are going, hallelujah. Let's get rid of some of this financial reform and let us start lending once again. And this is the reason we haven't seen a lot of lending going on in our country, because the banks have been too nervous. Now they're very optimistic that with some type of reform of Dodd-Frank, they'll be able to start lending once again. And if so, their earnings ought to do very well, and therefore their shares. So financial reform, watch it very, very closely. And again, the smalls and the mid caps, a lot of the financials trade in that category, and we touched on that. Biotech, pharmaceuticals, I'm going to lump those two together. The biotechs and the pharmaceuticals, this is probably the area that makes me the most nervous. We own them in our portfolios. I put them in there. They do well, and then they kind of peter out a little bit. Then they do well, and kind of go through this cycle. Not a lot of conviction right now, but there is a lot of hope that we are going to see a lot of reform. We saw what Hillary did. She basically came out and said, I can't even remember the exact words, nor do I want to, but basically they're a bubble, and then they're gouging people, and on and on and on. So is there some work that needs to be done in the pricing of various drugs and medications? Absolutely there is. But once again, we go back to Obamacare, get rid of some of the bad, keep some of the good. You got to see the pharmaceuticals, the biotechs, and pretty much anything medicine related, even the hospitals, do fairly well in the under the Trump administration. Infrastructure. Haley and I were talking as I was walking in. Did you see what just happened last night on Highway 50 on the downside, the west side of Highway 50 down by the falls there? Road gave away, down to one lane. Big old massive section gave away. Oroville Dam, big hole in it, having problems. We've got infrastructure problems like you cannot believe in this country. And of course, the president realizes this. So another area of the market that has everybody very excited is what we call infrastructure spending. And this is a very, very large swath of industries that could be positively affected, from companies making cement to companies that produce heavy equipment, to the contractors, to the general engineering firms. I mean, we all know every area that construction touches when it's strong. If we get an infrastructure bill that's passed by both the House and the Congress and signed by the president, this could be something like we haven't seen probably since the railroad boom in our country years and years ago. So an extremely, extremely important part of the economy going forward. And aerospace and defense. Then another hot area, but no one really understands why. Now, we all know we don't want to get into another war, but we do believe that, of course, that President Trump is going to be a little bit less tolerant of some of our enemies around the world. So kind of from Wall Street's perspective, they're looking at the Lockheed Martins and the Boeings and that type of thing to do well. We did see, back to the president, how he can drive a stock price down. We did see the impact that he could have on those companies when he was still, obviously, hadn't been sworn in yet. And he made some nasty tweets about Lockheed Martin and Boeing, about the price of Air Force One and the F-35 fighter and that type of thing. So he can bring them down, but it seems like they're holding hands and singing Kumbaya right now. So I think we're okay on the aerospace and defense. So that area ought to be pretty exciting going forward. In the final slide, I believe. Let's see. Look at my notes here. Yep. Changes may bring volatility. This I cannot emphasize enough. We are on a heck of a run right now. Don't get complacent in your portfolio. Pay attention to things. Understand what's going on. Watch Wall Street's reaction to various policies, procedures, tweets, these type of things coming out of the White House. And that'll kind of give you a perspective of what Wall Street is thinking, because sometimes, of course, what he's saying impacts the market. Sometimes it doesn't. The market kind of moves in these ebbs and flows where, like I said, sometimes he'll say something negative about the aerospace and defense, and the market kind of brushes it off. Other times they take it to heart and they begin selling off the stock of, like I said, Boeing, Lockheed Martin, that type of thing. But that goes for all aspects of the economy. You have to very, very much watch what he's saying, what the cabinet members that are still waiting to get, obviously, some of those sworn in, what they have to say about it. But the bottom line is the volatility is going to be here. It is not going to go anywhere. Right now, it's fun because the volatility is on the upside. Where it's not fun, and John gets more gray hairs, and I know most of you do too, is when it's on the downside. So just like I said, the best thing to do, watch, and become, if you already are not, educated and watch what's going on in the market. And then, are you growth-oriented or are you income-oriented? This is a point I'm trying to emphasize to investors very closely. As many of you begin to move through life and you maybe reach the milestone of retirement or you're close to it, keep in mind that you also have to shift your goals of your portfolio. And this is something we emphasize to our clients all the time. They'll come to us a year or two before retirement and they're 100% growth. Well, when we get into retirement, especially if we go through a market downturn, which is not a matter of if, but a matter of when, you don't want to see your retirement portfolio, your IRAs, 401ks, those type of things plummet, right? So start asking yourself, at what phase do I need to go from being a growth-oriented investor to an income-oriented investor? You can't really have both of them. You got to really choose which one you're going to be. And there's too many mistakes out there. Too many retirees enter into that beautiful time period called retirement, and they remain the same allocation as they had when they were working, which is the growth side. Then we go through a market correction, and here they come out of the woodwork and going, oh my God, I just lost 10, 20%. What do I do, John? Well, were you income or were you growth? And what's the difference? It's a significant difference. So I think this is, again, going to be a somewhat of a strategy, a trend that you really need to pay attention to under the Trump administration, because again, we're going to have this volatility, back to the other point, and the last thing you want to do is obviously succumb and lose some of your principal that you're going to need to produce income for yourselves in retirement. That wasn't too painful, was it? All right, you guys are smart. Let's open it up to Q&A. Yes, sir. Oh.
I have a question about algorithms and how much they affect the market and volatility.
Yeah.
And also, I just want to point out, I know when there's a bubble, it's when my sister-in-law decides to get into the market.
I understand. All right, algorithms and their influence on the market. Does everybody know what an algorithm is? If not, don't feel bad, because it's just a term that's been used just in the last couple of years. Okay, good. I don't see many hands. Good, so I can explain it. Bottom line, in English, it's a big old fancy computer program or programs. Sometimes on my show, I haven't mentioned this in a while, I'll say what the volume was for the day and how much of it was computer related or algorithmic trade related. So imagine that nowadays the human emotion is probably one of the biggest enemies of any of us that invest in the stock market. So to eliminate human emotion, they decided to put it into the hands of computers. So there are many firms, and it's growing with leaps and bounds, that utilize very high-powered computers. We all see IBM's Watson, right? and that's kind of an example of a computer that has some really, really strong algorithms and artificial intelligence, which is a whole nother hot area of the market. But bottom line is the computer is making split seconds, and I mean literally microsecond investment decisions, trying to capture a fraction of a penny move on the upside, or if they're shorting the market on the downside. But what it does to the rest of us that don't play in that sandbox is it makes it very, very difficult, because if and I'm going to make this really simple. I know some of you are computer oriented and you're going to go, oh, John, you missed it. Now, let me bring it really simple. Got this, high-powered computers or firms that have multiple high-powered computers. They plug in this program, this algorithmic program that they usually write themselves, kind of proprietary information, and they'll say if this, this, and this, and this happen in the market, the economy, buy or sell instantaneously. No human action. The computer automatically does it. But is it just buying a couple hundred shares or a couple thousand? No, it's buying hundreds of thousands. We all remember a few years ago the flash crash. Well, we thought that was related to a computer gone wild. Come to find out it was actually human intervention at that point. But this is the world that we find ourselves in, is we're battling the computers. And it's pretty tough to compete against those computers because, again, they don't use human emotion, obviously, at all. So this is a trend that's going to continue to influence the market. You've seen the New York Stock Exchange, for example, shrink down the number of floor traders they have. We've seen a lot of exchanges around the country close because they're going, computers are making the decisions. And so it's a very important part of investing and a very frustrating part of investing. I've said all along, I wish, at some point I could get a hold of a regulator at the SEC or something and say, you know what, if this thing continues to grow into algorithmic trading, you really need to create a completely separate exchange. I mean, there are many electronic exchanges right now, but where the computers, I mean, just visualize this, the computers are battling each other. Well, someone's going to lose, because right now when those computers go haywire or they're doing something they really shouldn't be doing, guess who suffers? The public, you and I.
Hi, Stephen Coppola.
Hey, Stephen.
You had mentioned that you believe there's a possibility or probability of a recession. Is that based upon the bond outlook?
Of a bubble.
Of a bubble?
Yes.
On the bond outlook?
Not so much that, Stephen. The bond outlook, again, you have to take the bond traders with a grain of salt, because they're usually negative Nancy's across the board. That's just why they exist in that world. But more so, again, the euphoria that's out there, and believe me, I'm the most optimistic guy in the world, but I've been around this train or been around this game for many, many years. You literally, again, can wake up one day and that optimism turns into pessimism for no reason other than people go, hey, I've made a pretty good amount of money this year. I'm going to move to the sidelines. And remember, the stock market works like a domino theory, right? If one big firm, usually it's a hedge fund, sells, then here comes the next one, and the next one, and the next one. And before you know it, you've had $1 trillion on the sell side, where a week ago or the day before it was on the buy side, and that creates the sell-off that can begin for no other reason than just taking profits. But people start to become very pessimistic at that point.
Okay, thank you.
You bet. Great question. Come on up.
Yeah, I'm Roger Edwards. I've lived through 2 stimulus packages in the last 2 administrations in the $1 trillion range, and I still see bridges falling apart everywhere, roads falling apart. Well, you can understand how the public is a little less than excited about the promise of another infrastructure stimulus,
Right.
when we haven't even paid off the last 2 yet. And how does that change until you spend another $1 trillion and hopefully we get some bridges fixed and that sort of
Well, I think it changes when hopefully we get some accountability in Washington. That's been the problem, right? It's they spend. That's why we have a $19 trillion. Well, I know that. That's one of the problems. Hopefully there will be under this administration, but politicians are politicians. But that's the only way that the infrastructure spending could work. And I think, to your point, Roger, I think if we started to see some spending going on where, let's say a massive contract was awarded, for example, to XYZ contractor, that I think would get the ball rolling, and I think that would bring in some optimism. They still haven't talked about, and this is what's got Wall Street a little leery on that point, how they're going to pay for it. Now, there's some talk raising the federal gas tax. There's some talk of issuing bonds. I mean, who knows what it could be. The bottom line is borrowing is very cheap right now by the Federal Reserve. I hope they're going to do some type of a bond offering and call it, the USA infrastructure bond or something to create some patriotic investing attitude, and then hold them accountable that they're going to spend the money and fix the infrastructure. That kept the economy afloat, according to them. Yeah, where is it? I don't know. That's a question for the politicians. Yeah, exactly. Yeah, Solera. Yes, sir.
With the replenishment of our water supplies, what do you see happening in the ag sector? And in particular in the Central Valley, in California?
Let me give you a national perspective. A great report just came out last week that farming across the nation, not so much, I'll come here locally in California in a moment, but around the nation, farmers are just terrified right now. And they're frustrated because this is what they're saying, is all I'm repeating. Look at Trump. You came to our farms, you came to our neighborhoods, you sat in our diners, and said you were going to, make sure that we're able to export our crops overseas. Now you're talking about, this tariff tax and so on and so forth, which is going to be negative. So therefore, Wall Street has come out just came out last week and gave a very, very dire prediction going forward, at least for the next 2 years for the commodity space, simply because they don't know what's going to happen on the tariff tax side of it. And then, of course, the repercussions. We've already heard Russia, which is a huge supplier, both importer and exporter of commodities, saying, look, if our sanctions are not lifted, so on and so forth, we're not going to be a big buyer. So the whole commodity space is very much in turbulence at this point because, again, they don't know what the Trump administration is going to do. And then back to my earlier point, a strengthening U.S. dollar, as you guys correctly mentioned, very bad for exports. So commodity space is very bad. And then I'll throw in a third point, which is a rising U.S. dollar obviously is bad for the commodity space in general. So I am not bullish on that. That's on the national basis. The local front, it's going to be interesting to see what happens. We still don't know what the damage is going to be. I mean, I saw a picture just last night of, I forget what the crop was, but it was an orchard of some type that was, 3 feet underwater. What's going to be the damage to that type of thing? I think this is probably not going to be a good year commodity-wise over the mountains. Hay-wise here, alfalfa production, you could see a massive amount. I know that's one thing I'm looking forward to. I mean, last year was the first year we could produce hay on our ranch in, probably 4 years. So I just had this discussion with my ranch manager this morning. We're really looking forward to strong hay production, but for those that want to sell it, it's going to be bad because it's the old supply and demand. There's going to be a whole bunch of supply and very little demand. So it'd be tough to be an alfalfa farmer trying to sell, that crop per se, because there's going to be a glut of it this year. And without exporting. Yeah, good point. That's exactly right. Any other questions?
More questions.
No problem.
John,
Yes, sir.
how successful do you think Trump will be, even with reducing the rate of income tax for companies who want to bring money back? How successful will he be in actually getting manufacturing back into the United States?
Excellent question. How successful will Trump be as far as what we call repatriating money, bringing money back in from overseas, as well as manufacturing? I think he's going to be extremely successful. I really do. There are trillions and trillions. No one can really identify the exact amount, but there are trillions of dollars back to Fortune 500 companies, made all this money overseas. They don't want to bring it back here to the U.S. because of the current tax rate. So lowering the tax rate, number one, would be very effective. But I think also what I'm expecting, and I think it would be in this tax reform package, is, for very simplistic terms, call it basically a tax holiday, right? We're going to give you 30 days, XYZ Corporation, to repatriate that money back over to the U.S. at a very low tax rate, maybe 10%, somewhere around there. Again, it's going to be a boon for these companies by doing so. The manufacturing side of things, we've got this challenge going on right now where so many jobs have been lost in this country, unfortunately. And I've said this for years. I hate to say it, and it pains me to say it, but those jobs are not going to come back. They're not going to come back, and I'll tell you why. Corporate America, big or small, has become very, very used to squeezing the turnip to produce every ounce of juice possible. They have learned how to survive from the credit crisis through now on improving not so much the bottom line, the earnings per share, but the top line, the revenue side of things, through efficiencies, through job cuts, because for most businesses, payroll is their number one expense. So all of a sudden, just because we have a new administration, they're going, wait a minute, we don't want to go back to the old ways, being fat, dumb, and happy with too many people, right? So I don't think those jobs are going to come back. Secondly, you have the advent, like I said, this artificial intelligence. I mean, how many of you picked up this, what's it called, Ray? The Amazon Echo or the Alexa, thank you. I mean, this thing is this, for $200, it's doing all kinds of things. And we're starting to see it in the world of investing also. So, you've got artificial intelligence that's going to eliminate a lot of jobs. The manufacturing side, I think we're going to have some good growth. It has just been a struggling every Friday, or once a month on Fridays when I cover the non-farm payroll numbers on my show. I always touch on what each industry has done as far as the job growth or job loss. And the manufacturing has just been terrible for years. We're now starting to see it when we had the report a couple of weeks ago. We're now starting to see that edge up just a little bit. For the first time, CEOs are going, hey, we do have an incentive to create jobs and build factories and things here in the US. But again, it's going to come down to the tax reform. And that's why I keep coming back to that issue. If the taxes can't be adjusted lower, they're going to say, wait a minute here, I can still produce that widget overseas at, you know, if you go to Ireland, you're at 11, 12% effective tax rate versus our numbers here at home. So this is why that so many things are hinging on this tax reform package. Great question.
A couple of people you've got, John, you want to introduce them?
Sure. Ann Cohn is our digital media manager and is responsible for all aspects of social media for our firm. Facebook Live, Twitter, you name the social media, as well as the podcast. Jake Parker, who's my producer of the show, gets it on iTunes every single day, and then Ann coordinates it all. And Haley, our COO, she just tells us all what to do and make sure it's all done. No, she orchestrates the whole thing. It's just, oh boy, does she ever? Does she ever? Yeah, I was very slow to social media, and thanks to these two ladies and others back at the office, it's a lot of fun. It really is. We're having a great time with it, and it's so neat to get a phone caller from somebody. We had one, I don't know, a year or so ago from Brazil that was listening online or the podcast. But those of you that are trying to go, attract the millennial generation, let me tell you, folks, the podcast is how they're doing it. They're not listening to the show at 5 o'clock. They're downloading it, putting it on their iPhone or their smartphone, listening to it on their commute or while they're working out the next day. It's an entire fun medium. It really is.
John, I think you said it all. I was working because I was sort of tracking John this last one, and he had 1,100 pre-shows. That's about 100 times, about 10 times more than anyone else has ever had.
Wonderful.
It's because of his connections in social media, his SEO, and his links. I was working on my computer on my desk, and all of a sudden in the corner pops up that he's live on Facebook, and step in and watch him. So that's the future. I want to congratulate you on your people and the quality you have.
I have the easy part. They have the hard part. So thank you guys. You're on.
Gold and silver. Where's it going?
Down. It's a tough trade at this point. What Wall Street's looking at, again, you hear me again, the U.S. dollar strength. It's like clockwork. The dollar rises, the gold prices come down. Silver's a little bit better for various reasons, but I think it's dead capital at this point. Should it be part of a portfolio? Sure, maybe 5% for the average person, but I just would not expect anything great out of it, just simply because of the economic strength. Now, again, the only time that would change that perception or that prediction would be if the market does start to go down. We have a terrorist attack or big economic turmoil, then of course it'll become the safe haven. But right now, based upon what's going on, the traders are just watching the dollar, and then they're bringing the price either flat or down.
First off, thank you for being here.
Thank you.
I love listening to your show. I love hearing you in the morning, getting updates. But in investment turn here. Obviously, nationally, we had some great things happen. Locally, we kind of got smacked in the face. I'm wondering about the incentives that have been given to businesses to come here, and yet, we basically have a Democrat legislature right now. What do you see as being a good area for investment right now, and what is a bad area locally?
Well, that's a tough one. A good investment locally. I would say you watch the likes, and I can't, for compliance reasons, I can't recommend any stocks, so don't take this as a stock recommendation, but the likes of a Tesla, a company that comes here that is doing a lot of things and a lot of right things. They're doing some wrong things, in my opinion, but for the most part, doing right things, and looking to see, what companies, publicly traded companies, are coming here that are on the growth path. We had Eldorado Casino have a big acquisition a few months ago. So we have a lot of companies that are very active, in the national stock market space, meaning any of the national exchanges. I think we're just going to continue to grow here. I hope that we can do it right this time. I hope we don't stumble for the reasons that you were just mentioning, and the word continues to be spread that we are the next place to be. I don't know why any corporation would not want to come here. Anybody else? Yes, sir.
Well, actually, there was 50, but one.
I'm always concerned when the government makes deals with my money, but how about the Faraday future and the Tesla thing and all that sort of thing? How do you see these giveaways, compromises, accommodations ending up in the long run?
I'm with you on that. We saw, of course, what government give away to Solarium and that failed during the Obama administration. It's a chance that you got to take. It's just like if all of us in this room were venture capitalists, we would be deciding, are we going to invest in XYZ company? We know the risk, we know the rewards. And I think that's what we've done here locally with Tesla. One that never gets much mention is, I'm drawing a blank right now, the sporting goods store by Boomtown. Cabela's, thank you. Cabela's got some very fat tax incentives, and now they're bought by Bass Pro Shop. So it's an investment, and the way that I look at it is it's better than not doing anything. I mean, you look at the growth of real estate, you look at the number of people that are coming in, and I talk to a ton of real estate people. We are, you hear the term and everybody's tired of hearing it, but it is reality. This Tesla effect, the higher end homes that were not moving before are now moving to the executives of Tesla and Panasonic and that type of thing. But more importantly, it's also just what it's done. I had a commercial real estate broker on the show the other night, and he said, we are fielding calls, and I hear this from numerous brokers. We're fielding calls from countries or from companies around the world because they hear what's going on. So that's worth something. My biggest concern is, and I've said this all along, I think Tesla, if we're going to pick on them, yeah, they're going to make cars for their battery, but they've already proven it, and I predicted this. They've got bigger plans, right? They just bought Solar City, which Elon Musk, of course, had ownership in it. There's some big plans coming, and I like that they're moving away from the government subsidies of the batteries for the cars and moving into some of these other areas where they're not relying. Because that was my biggest fear of them coming is what happens if that cash flow drains up? Because a lot of their earnings are derived from the government subsidies to the battery wall. Yep, that's exactly what I'm talking about. Yep. Oh, absolutely, it'll be worldwide. No doubt in my mind about that. Yes.
Hi, John.
Hi there.
REITs have been the best performing asset class for a number of years, but that's while interest rates were coming down. Now that interest rates are going up, what do you foresee for REITs?
We prefer the non-traded that are not relying upon the interest rate cycle. For a publicly traded REIT, which remember there's two types, non-traded and then traded. I don't like the traded ones for exactly what you said. You're absolutely correct on that. The non-traded are not interest rate sensitive from that standpoint. They actually want a little bit higher interest rate because the cap rate, there's a mathematical formula doing the cap rate. They actually can make more money in the long term in a, not a high rising, but a little bit higher rising interest rate environment than we find ourselves in now. So it's like everything. You got to do your due diligence on it and understand the company. All right. Anybody else? All right.
Is there more? Is there more?
Well, I want to thank all of you and the Republicans Men's Club for having me. What a great time this has been. Let's make this country great again, as President Trump says. I think we've got everything in place to do it. It's all pulled together and make it happen. So thank you.
Thank you, John.
Thank you for listening to this episode. Now, if you could do us a favor and subscribe right over here, little RMC ball, just hit that and subscribe, and we'll see you next month at the RMC dinner. Take care.